Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. How to invest in real estate development projects for strong returns, 2025 guide. Real estate development projects are drawing investors looking for strong returns beyond traditional property purchases. Unlike buying existing homes or rentals, development lets you shape a project from the ground up, potentially increasing profits if done right. But higher rewards come with higher risks, making smart planning and risk management non-negotiable. With demand for housing and commercial spaces growing, strategic investments in development can pay off long-term. Whether it's residential communities, mixed-use buildings, or commercial hubs, understanding market trends and local regulations is key. Let's break down how to approach these projects carefully and profitably. Understanding real estate development projects. Real estate development projects transform raw land or existing properties into residential, commercial, or mixed-use spaces. It's more than just construction. Every project follows a structured process from planning to completion, involving multiple players and careful financial planning. Types of real estate development projects. Developers categorize projects based on their end use. Each type has unique risks, timelines, and profit potential. Residential developments. These focus on housing and fall into two main categories: single-family homes, standalone properties targeting families or individuals. Lower density means higher land costs per unit. Multifamily properties, apartments, townhouses, or condos that maximize land use. High demand in urban areas drives steady cash flow. Commercial developments. Built for business use, these include office spaces, ranging from skyscrapers to business parks. Demand fluctuates with economic trends. Retail centers, shopping malls, strip plazas, or standalone stores. Tenant mix and location dictate success. Industrial developments, warehouses, factories, and logistics hubs support e-commerce and manufacturing. Rising demand for last-mile delivery spaces has boosted this sector. Mixed-use developments combines residential, retail, and office spaces in one project. These create walkable communities but require complex zoning approvals. Key players in development projects. A successful project relies on collaboration between several experts. Developers. They lead the project, securing funding, buying land, and overseeing construction. Their vision shapes the final product. Investors provide capital in exchange for equity or fixed returns. Banks, private equity firms, and crowdfunding platforms often step in. Architects and engineers turn ideas into buildable plans while ensuring safety and efficiency. Their designs impact costs and timelines. Contractors handle construction, hiring subcontractors for specialized work. Delays or budget overruns often start here. Local governments approve permits, enforce zoning laws, and inspect progress. Regulations can make or break a project. Understanding these roles helps you see where risks and opportunities lie. Next, we'll break down the step-by-step phases of development, from empty lots to finished buildings. Investment strategies for real estate development. Choosing how to invest in real estate development depends on your goals, risk tolerance, and available capital. Some investors jump directly into managing projects, while others prefer hands-off options. Each route has its own set of advantages. Understanding them helps you pick the right fit. Direct investment in development projects. Going all in on a development project means you control the process from start to finish. It demands expertise, patience, and careful planning, but the payoff can be substantial if done right. The steps usually break down like this. Sourcing the deal. Finding the right opportunity involves networking with developers, scouting undervalued land, or identifying gaps in local markets. A prime location with high demand is non-negotiable. Securing financing. Banks, private lenders, or joint ventures fund projects, but loans often require strong credit and a solid exit strategy. Hard money lenders are faster but expensive. Managing construction. Delays and cost overruns are common, so strong oversight is critical. Hiring reliable contractors and staying on top of timelines ensures smooth progress. Leasing or selling. Once complete, properties can generate income through rentals or be sold for profit. Market timing matters. Selling during a high-demand cycle boosts returns. Direct investing works best if you have experience or a trusted team. Mistakes in planning or execution can erode margins quickly. Indirect investment options. Not everyone has the time or capital to oversee a full project. Thankfully, alternatives exist. REITs, real estate investment trusts. These publicly traded companies pool investor funds to buy and manage properties. They offer liquidity, diversification, and passive income without the headaches of construction. Just research fees and performance history before jumping in. Crowdfunding. Online platforms let you invest smaller amounts in specific projects. Returns vary based on success, so spread investments across multiple developments to reduce risk. Syndication. Groups pool money to fund larger deals led by experienced developers. Investors get partial ownership and returns without hands-on management. Vetting the sponsor's track record is key. Indirect options provide exposure with less responsibility. While returns may be lower, they offer flexibility and lower entry costs. Market trends and location always influence outcomes. Industrial spaces near logistics hubs, for example, have grown in demand due to e-commerce. Feasibility studies help spot risks early. Ignoring them can be costly. Whether you dive in directly or take a passive approach, aligning strategy with market conditions keeps investments profitable. Risk assessment and mitigation. Every investment has risks, but real estate development brings a unique set. Economic shifts, legal hurdles, and construction surprises can derail even the strongest projects. Smart investors don't just hope for the best, they plan for the worst. Here's how to spot common pitfalls and minimize their impact. Market risk and economic factors. Real estate lives and dies by the economy. When interest rates rise, borrowing gets expensive, squeezing profit margins. A recession can gut demand for new luxury condos, while booming job markets might make industrial parks gold mines. To stay ahead, study local cycles. Markets don't move uniformly. A city with growing tech jobs may support apartments despite national downturns. Lock in rates early. Secure financing before hikes hit. Flexible loan terms, like rate caps, buy breathing room. Diversify project types. Balance high-risk commercial builds with steadier residential rentals to spread exposure. Economic shifts are inevitable, but timing and location soften the blows. That's it for Part 1. Stay tuned for Part 2, where we'll dive deeper into advanced strategies and tips. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.